Good day and welcome to the D-Marq-AnalyticS channel. In this week's video, we will look into an interesting topic: behavioral economics for investors, Buffett's Unwritten Rules Introduction, the Contrarian Revelation. Most investors think Warren Buffett's edge comes from spreadsheets, valuation models, and decades of experience. But here's the truth: Buffett's real superpower isn't math, it's psychology. While the rest of the market reacts to headlines, dopamine spikes, and fear cycles, Buffett follows a set of unwritten behavioral rules that protect him from his own human instincts. Today, we're going to break down the hidden mental framework behind Buffett-style investing, the psychological moat, the biological glitch of loss aversion, the architecture of the herd, and how modern AI tools can help you exploit emotional mispricing in real time. If you've ever wondered why two investors can look at the same stock and make completely opposite decisions, this video will give you the answer. Let's begin. When Buffett talks about a moat, most investors think of pricing power, brand loyalty, or network effects. But there's a deeper layer he rarely talks about. A moat is also a psychological barrier, a shield against your own impulsivity. Because here's the uncomfortable truth: most investors don't lose to the market, they lose to themselves. Traditional fundamental analysis looks at cash flows, margins, competitive advantage. It's rational, structured, and slow. But the market doesn't move rationally. During high-frequency trading spikes, investors experience a neurochemical response. Cortisol rises, dopamine drops, and the brain shifts into threat avoidance mode. This is why a stock can drop 5% in 10 minutes, and suddenly everyone forgets the fundamentals. Enter cognitive arbitrage. This is the modern value investor's secret weapon. Cognitive arbitrage is the ability to stay rational while others are emotional, slow down while others speed up, think long-term while others chase the next candle. Buffett's moat isn't just around the business, it's around his mindset. And that brings us to the next rule. Humans are wired with a biological glitch. We feel losses twice as intensely as gains. A 10% market dip triggers the same neural pathways as a physical threat. Your midbrain literally thinks you're in danger. This is why retail investors panic sell, not because of logic, but because their biology is screaming at them. Neuro-AI data confirms this. Modern volatility algorithms detect patterns in retail order flow that correlate with panic responses. When volatility spikes, retail sells, institutions buy, algorithms amplify the emotional cycle. Buffett's famous line, "Be fearful when others are greedy, and greedy when others are fearful," is actually a dopamine strategy. When others panic, their dopamine crashes. When Buffett buys, he's acting from a place of emotional neutrality. He's not fearless, he's regulated. And that's the difference. In the 2026 digital economy, markets don't move on fundamentals. They move on sentiment loops. A rumor on X becomes a trend becomes a narrative becomes a price movement. This creates artificial price ceilings and floors, not because the business changed, but because the conversation changed. The neural triggers behind herd behavior. Mirror neurons push us to copy others. Social validation feels safer than independent thinking. Fear of missing out overrides valuation logic. Short-term dopamine hits replace long-term compounding. This is why investors abandon value ratios and chase momentum. Information cascades. An information cascade happens when people stop thinking independently. They rely on what others are doing. Price decouples from utility. The herd becomes self-reinforcing. Buffett avoids cascades by ignoring the crowd entirely. He doesn't check stock prices during panics. He checks business performance. That's the architecture of rationality. Now let's bridge Buffett's patience with modern tools. Buffett didn't have real-time AI sentiment analysis. You do. AI can now detect emotional mispricing. Neuro-AI tools can flag panic clusters, sentiment reversals, overreaction zones, retail capitulation points. This is where Buffett's philosophy meets modern execution. Calibrating entry points. When neuro-AI signals a peak in pessimism, volume spikes, sentiment collapses, retail exits, institutions quietly accumulate. This is your window. Buffett calls it opportunity. AI calls it statistical deviation. You should call it buying time. From gut feeling to bias detection checklist. Instead of relying on intuition, build a checklist. Is the panic emotional or fundamental? Has sentiment diverged from earnings? Are insiders buying? Is the business unchanged? Is the price dislocated from intrinsic value? Are algorithms amplifying fear? This is how you turn Buffett's qualitative wisdom into a quantitative system. Now let's talk execution. 1. Automate decisions to bypass emotional interference. Your midbrain is the enemy. Automation is the moat. Set rules for rebalancing, buying dips, position sizing, stop-loss avoidance, dollar cost averaging. The less you rely on emotion, the more you rely on process. 2. Integrate decentralized assets and AI-driven valuations. The modern value investor isn't limited to stocks. Decentralized assets, tokenized cash flows, and AI-priced risk models give you a broader universe of opportunities. Buffett's principles still apply. The tools have evolved. 3. Become a net buyer of fear. This is the ultimate Buffett rule. When the world panics, you accumulate. When the world chases, you wait. When the world speculates, you analyze. In an increasingly automated and volatile financial landscape, the investor who masters psychology, not spreadsheets, becomes the titan. If you take one thing from this video, let it be this. Markets are a psychological battlefield. Your edge is emotional discipline. Buffett's unwritten rules aren't mystical. They're behavioral, they're repeatable, and they're available to anyone willing to think independently. If you want more videos like this, deep dives into behavioral finance, AI-driven investing, and rational portfolio construction, make sure you subscribe. And remember, be a student of behavior, not noise. If you found this week's topic thought-provoking or helpful in any way, kindly hit the like button. Share this video with anyone you think might find this topic interesting. Please feel free to subscribe if you'd like. We would like to thank you all for staying till the end, and we wish you all have a wonderful day ahead.